a fenced lot. Rows of gray metal boxes lined up in a perfect grid. No landscaping, no lobby, barely a customer walking through on any given day. Look at it, and you'd assume this is the easiest money in all of real estate. No plumbing to fix, no tenants to manage, no phone ringing at 2 in the morning. Just a padlock, a keypad, and a monthly charge that shows up on someone's credit card statement whether they've thought about that unit in 6 months or not. And yet the United States now has more self-storage facilities than McDonald's, Starbucks, and Subway locations combined. Tens of thousands of them, quietly outnumbering the businesses we actually think about every day, sitting in industrial parks and off-highway exits, easy to drive past without a second glance. Here's the twist, and it shows up early because it has to. This industry isn't really selling storage space. It's selling human inertia. The entire model rests on one quiet bet, that once your stuff goes into that box, you're far more likely to keep paying than you are to ever come back and move it out. The rent isn't really for storage. It's closer to a tax on procrastination. So who actually gets to own one of these things? At the bottom end, you're building from raw land, permits, concrete, steel, security cameras, and for a mid-size facility, that bill can easily run into 7 figures before you've rented a single unit. At the top end, you're bidding against public REITs, with billion-dollar balance sheets for anything already stabilized and cash flowing. Somewhere in between sits the gap where most individual investors actually live. Below roughly 50,000 square feet, the big institutional names, Public Storage, Extra Space, CubeSmart, typically pass. Not worth their time. That segment falls to private operators, regional players, and self-funded investors willing to do the unglamorous work of running a smaller site. Less competition from giants running pricing algorithms. Also, less of their leverage. Financing is a big part of why this asset class is more accessible than people assume. SBA 7A. Loans can fund the purchase or construction of a facility with terms stretching up to 25 years. A level of patience banks rarely extend to a restaurant or a retail shop, where 5 or 10 years is closer to the norm. That single fact has quietly pulled thousands of ordinary investors into an industry that used to belong almost entirely to developers and real estate syndicates. It also explains why the buyer pool looks so lopsided today. On one side, 4 publicly traded REITs, Public Storage, Extra Space, CubeSmart, and Life Storage, dominate the institutional end, competing for anything large enough and stabilized enough to move the needle on a billion-dollar balance sheet. On the other side, an entire tier of private operators, regional roll-ups, and individual buyers picks up everything the REITs consider too small to bother with. Neither side is really competing with the other. They're just fishing in different parts of the same lake. But accessible isn't the same as safe. Right before storage became one of the hottest asset classes in commercial real estate, something happened to the price of getting in. By the end of 2022, capitalization rates on self-storage properties had fallen to an all-time low of 5%, meaning investors were willing to accept a smaller and smaller annual return in exchange for owning one of these buildings, a sure sign that everyone had decided the risk had basically disappeared. Buyers had never paid more, relative to income, to own one of these boring metal boxes. Cheap money, record prices. Everybody convinced the asset was exactly as safe as it looked. That was the moment right before everything turned. Hang on to it, because we're coming back to it. First, though, the actual money. Strip away the fencing and the concrete, and a storage facility is a stack of income layers, thin on their own, heavier once you put them together. Layer 1 is base rent. Nationally, storage generates somewhere between $14 and $17 a year for every rentable square foot. That's the baseline, and it hides an enormous range. The best performing facilities in strong markets pull in $22, sometimes $30+ per square foot. Same size box, same steel, 2 or 3 times the income, purely because of where it sits and how it's priced. A unit in a dense coastal city, where the alternative is renting a bigger apartment, is worth far more than the identical unit off a rural highway exit, where the alternative is just building a shed in the backyard. Layer 2 is the unit mix premium, and this is where the real money starts showing up. Add climate control, and that unit alone can command 30 to 50% more revenue per square foot than a plain drive-up unit sitting right next to it. Same footprint, same concrete pad. The only difference is a compressor and some insulation, and suddenly that 10 by 10 is worth half again as much. Modern facilities now dedicate 30 to 60% of their square footage to climate control, not a luxury add-on anymore. The profit engine. Layer 3 is where this stops looking like retail and starts looking like a casino running 2 tables at once. Every facility quietly operates 2 pricing systems in parallel, a street rate for whoever's searching storage units near me today, and a separate, usually higher, schedule for the people already inside, boxes already unloaded, lease already signed. New customers see the low number. Existing tenants get worked on a completely different clock, one that operators track down to the individual customer, using software that factors in zip code, income level, how long you've stayed, and even how competitors nearby are pricing that exact week. It's the same revenue management logic airlines used to charge 2 people sitting next to each other completely different fares for the identical seat. Except here the seat is a steel box you've already filled with your belongings, which makes switching flights a lot harder than switching storage units in theory, and, as it turns out, in practice too. We'll come back to this because it's the single most important mechanism in the entire business. Layer 4 is everything that isn't the unit itself. Tenant insurance, sold almost as an afterthought at move-in, and quietly one of the highest margin products in the whole operation. Late fees, lock sales, boxes and packing tape at the counter, third-party management fees if you're big enough to run other people's facilities for a cut. None of it shows up in the headline rent number. Tenant insurance alone is worth dwelling on for a second, because the facility usually isn't underwriting the risk itself. It's just the middleman collecting a fee for pointing a policy at you during the sign-up flow, the same way an airline makes money bundling in trip insurance at checkout. Almost pure margin, attached to almost every single lease. Stacked across hundreds of units, it moves the bottom line more than you'd think. Layer 5 is the one that actually explains why investors love this asset class. The margin itself. Take a fairly typical 50,000 square foot facility. Operating costs, payroll, insurance, utilities, maintenance, property tax, run around $175,000 a year. Gross revenue on that same facility can land near $600,000. Do the subtraction, and you're looking at close to $425,000 in net operating income before debt service. A margin in the 30 to 50% range. Most commercial real estate, office towers, retail strips, apartment buildings, struggles to clear half of that. Storage does it almost by accident, because the business barely needs any people to run it. 100 more units doesn't mean 100 more employees. It might not mean any more employees at all. One manager, a camera system, and an app can run hundreds of tenants with almost nobody on site most of the day. Compare that to an apartment building the same size, where a leasing office, a maintenance crew, and a superintendent are just the cost of staying open. And it starts to make sense why institutional money fell so hard for this asset class over the last decade. It behaves like a business with almost no moving parts, attached to real estate that almost never sits fully empty. But that 2-tier pricing system sitting quietly in Layer 3 isn't just a clever revenue trick in the background. It's the actual engine underneath everything, and there are 2 traps built on top of it, stacked like a loaded spring. Call the first one the law of inertia. You sign up at the advertised rate, maybe even a move-in special. First month free, half off for 3 months. Feels like a deal. You unload your boxes, your old furniture, the treadmill you swore you'd use. Then, month after month, the rate creeps upward. 5% here, 8% there. Never all at once. That would spook you into leaving. Just often enough that by year 2 or 3, you're paying noticeably more than someone who signed up last week for the identical unit down the row. Here's why it works, and it's almost embarrassingly simple. Operators have learned that customers systematically underestimate how long they'll actually keep paying. You think you'll grab your stuff back out in 3 months. The industry's own numbers say you won't. You'll still be paying in year 2, year 3, sometimes year 5, and every rent increase notice runs through the same private calculation. Is this hike worth the hassle of renting a truck, taking a day off work, and hauling everything out yourself? Almost every time, the hassle wins. The rent increase gets paid. Picture 2 identical 10 by 10 units, side by side in the same building. One is rented by someone who moved in 18 months ago at $100 a month and has been quietly bumped up every few quarters since. The other is rented by someone who signed a lease last week, drawn in by an online promotion, paying $80 for the exact same square footage. Same lock, same door, same concrete floor. The only difference between them is how recently each tenant last thought hard about whether they still need the unit at all. That gap is not an accident of the market. It is the market, functioning exactly as designed. This is exactly why the largest operators can say, openly, in their own trade publications, that they hold advertised rates flat, sometimes even cut them, to win new tenants, while simultaneously running some of the most aggressive existing tenant increases anywhere in commercial real estate. 2 completely different games, played on the same building at the same time. New customers see the industry's low price. Existing tenants are the industry's actual profit engine. That's trap 1, slow, quiet, works in almost any economy. Trap 2 is faster, and it's the one that actually breaks things. Between 2020 and 2022, money was cheap. Interest rates sat near zero. Investors piled into storage because the returns looked extraordinary, and the sector had sailed through the pandemic almost untouched. Cap rates collapsed to that all-time low of 5% by the end of 2022. Everyone wanted in, so developers built. Construction spending on new self-storage hit $6.9 billion in 2023 alone, a 24% jump in a single year, much of it financed on floating-rate debt, because rates were low and nobody expected them to move. Then the Federal Reserve moved 11 times. Prime rate went from 3.5% to 8.5%. Overnight lending rates jumped from essentially 0 to 5%. Here's where the domino actually falls. Those 2 shifts landed at the same moment. New supply flooded into markets that historically took years to lease up, while every facility sitting on floating-rate debt was suddenly paying 2 or 3 times what it had budgeted for interest. And, in the newly oversupplied markets, cutting street rates just to compete for the same shrinking pool of new tenants. Rising debt cost, falling ability to raise rent, both hitting the same buildings, bought at the most expensive prices this industry had ever seen. Think about what that actually does to a facility's math. A property underwritten in 2021 assumed a certain interest expense, a certain occupancy, a certain rate of rent growth, all baked into a business plan that made sense at the time. 2 years later, every one of those assumptions had moved against the owner simultaneously. Not one variable drifting slowly, but 3 variables snapping at once, on properties that had almost no room in the budget to absorb any of them, because the underwriting had been done at the tightest margins the industry had ever accepted. Abandoned storage developments rose by over 100% in a single stretch. Deferred projects jumped more than 40%. Buildings marketed as bulletproof, recession-proof, boring and safe were suddenly the ones getting foreclosed on, refinanced under duress, or sold at a loss to the very institutional buyers who'd sat out the top of the market. 2 real companies show exactly what that split looks like in practice. Start with the story that sold everyone on this business in the first place. In 1972, a real estate developer named B. Wayne Hughes took a trip to Texas and saw something he'd never seen before. A mini warehouse facility, just rows of small units rented by the month. He went home to California, partnered with a friend named Kenneth Volk, and together they put up $50,000 to build a prototype in El Cajon. They almost called it private storage spaces. When people kept assuming that meant it wasn't open to the public, they flipped the name, public storage. The first few months were rough. That prototype broke even at only 35% occupancy, and nothing about it looked like the start of an empire. But the two men kept building anyway, treating each site as almost disposable. Cheap land, cheap construction, we'll redevelop it later if storage doesn't work out. They painted the doors bright orange so drivers would notice the buildings from the highway, and at the grand opening of that very first site, they threw a party with mariachi music to pull in curious neighbors. The first customer through the door was a distributor who just needed somewhere to stash cans of motor oil that his wife wanted out of the driveway. Not exactly the founding myth of a Fortune 500 company, but storage worked out. By 2024, Public Storage sat in the S&P 500, running more than 3,000 facilities across the country, pulling in $4.69 billion a year in revenue, holding close to $20 billion in total assets, $50,000 in seed money, and a prototype that barely broke even, turned over 5 decades into one of the largest real estate investment trusts on the planet. Hughes ran the company for decades afterward, and by the time he passed away in 2021, the business he'd started on a whim in a Texas parking lot had grown into equity stakes across more than 3,000 properties and over 200 million square feet of rentable space. Now the other ending. What happens when the same cheap money cycle turns against you instead of for you? SmartStop Self-Storage REIT built a real portfolio during the boom years, financing part of it with the same floating rate debt that looked nearly free back in 2021, tied to short-term benchmarks like SOFR that moved in lockstep with the Fed. On paper, floating debt made sense at the time. Rates were near zero, spreads were tight, and locking in a fixed rate would have meant paying a premium to insure against a hike almost nobody was forecasting. By the first quarter of 2024, the weighted average interest rate across SmartStop's consolidated debt had climbed to roughly 1%, more than double what floating-rate borrowers were paying 2 years earlier, and layered with covenants where the spread the company paid over the benchmark actually widened further as its leverage ratio ticked up, meaning the higher rate squeezed harder exactly when the company could least afford it. On a large debt load, that isn't a rounding error. It's a much bigger slice of every dollar collected in rent suddenly going to interest instead of investors, and it wasn't happening in isolation. Across the sector, self-storage valuations had peaked at $174 per square foot in early 2023, then fell for 6 consecutive quarters straight, down to around $159. Not a single bad quarter that bounced back, a sustained year-and-a-half slide. The same building, generating roughly the same rent roll, worth noticeably less on paper, while costing meaningfully more to finance, all at once. That's the leverage trap with a real name and a real balance sheet attached. Nobody at SmartStop did anything reckless by 2021 standards. Floating rate debt was simply the norm when money was cheap and storage looked bulletproof. The trap wasn't a bad decision. It was good timing quietly turning into bad timing because the whole industry made the same bet in the same window, and the Fed changed the rules on all of them at once. So which one are you actually buying into if you put money into a storage facility today? The best case looks like this. You buy into a market that isn't oversupplied. You finance with fixed-rate debt, so the Fed's next move doesn't touch your monthly payment, and you let the two engines underneath do their quiet work. New tenants trickling in at a competitive rate, existing tenants slowly, patiently paying more than they realize year after year because moving a storage unit is always more annoying than absorbing a rent increase. Run that for a decade in the right location, and you get something close to the public storage story. Boring, unglamorous, compounding the entire time. The worst case looks like SmartStop's balance sheet in 2024. Floating rate debt that felt cheap the day it was signed in a market suddenly hit with supply right as the Fed started moving, financing costs climbing while the asset's value fell for 6 straight quarters. In that version, the same patient inertia tax is still being collected from tenants every month, quietly working exactly as designed. It just isn't enough to outrun what's happening on the other side of the ledger, where the debt is compounding faster than the rent increases can catch up. Same steel boxes, same tenants. Completely different outcome, and the difference was never the boxes. It was the timing and the leverage sitting quietly underneath them. That's really the whole lesson hiding inside this industry. Storage looks like the simplest asset class in commercial real estate. Right up until interest rates move, and it's revealed to be one of the more leveraged, more cyclical bets you can make, just wearing a very boring disguise. Nobody pitches storage the way they pitch a tech startup or a crypto exchange. It gets pitched as the anti-hype investment, steady, grinding, almost embarrassingly dull. And for long stretches of time, that pitch is accurate. It's only during the 18 months when a sector's cheap debt turns expensive all at once that the dullness gets stripped away, and you can see the actual machinery underneath. Leverage, timing, and a very large number of people quietly not moving their stuff. That disguise is the entire point. Go back to that image from the start. More self-storage facilities in America than McDonald's, Starbucks, and Subway combined, all of it sitting there quietly, humming along, collecting rent from people who tell themselves they'll come get their stuff next month. They won't. Most of them won't. And that's not a flaw in the business model. It is the business model. Storage doesn't make its money by storing your things. It makes its money by betting, correctly, that you'll never come back for them.